Sharing your thoughts. Thanks so much for stopping by and filling us in with your view on a whole host of sectors that we just discussed. But let's focus on another company, Honeywell Automation. Well, they posted yet another subdued set of numbers in terms of margins. Revenues grew, and that's heartening. Execution is picking up. The problem is on the margin front, which came in at multi-year lows. It was much lower than Nomura's estimates as well, of around 18%. To understand what went on in the past quarter, and more importantly, what's the way ahead, Mr. Ashish Gaikwad, the MD of Honeywell Automation, joins us. Hi, Mr. Gaikwad. Good morning. The last time you were telling us no crystal ball gazing, but we'd like to know some bit of, a way ahead and some kind of a path out there. So let's get straight to it. Execution's improved. That's heartening. The problem is margins. And, I want to focus on two aspects. One is on the export side of things. Has there been a change in the pricing model with the parent? Point number one. Or is the problem on the domestic side? When you're executing some of these smart city projects, has there been, some skimming off on margins on that front? Please go ahead, sir. Tell us why the margins were so depressed.
Well, good morning, Nigel, and thanks for having me on your show today. Let's look at the positives first in the quarter, Nigel, if you allow me. Number one is we have posted 18% increase in the PBT and also the PAT, right, in the absolute terms. Also, if you see, this quarter is a record quarter. I'm talking about the October to December. So first time in the history of this company, we've crossed 1,000 crore revenue mark, right? So that's positive as well. And when you look at the YTD margins, the 3 quarters margins, they have shown some improvement. Of course, for the particular quarter of October to December, I agree with you that we could have done better. Gross margins have dipped a little bit, maybe about 20 bips. And that is a combination of a few things. Number one, we still are burning the backlog from FY21 and 22. And as I had discussed with you in our previous conversations, the margins had been suppressed, and we continue to see that. The second, of course, is the mix. The kind of mix that we are getting in the market, we have to juggle that better, and we will continue to look for opportunities. And the third thing is inflation. It's not still gone away. It continues to surprise us, and we need to find better ways to deal with the inflation. Coming back to your other part of the question, Nigel, that are there any changes in the exports related pricing? No, there is no change. We continue to have the same. But yes, there are margin pressures on the domestic large programs that we have undertaken in the past.
Sure.
Mr. Gaikwad, sorry, just one thing, actually two. You said profits are up 18%, but that's largely on account of other income, right? There's a boost from the other income front, one. And two, you said gross margins are down 20. I thought on a year-on-year basis, they're down almost, they're down what, 650 basis points on a year-on-year basis?
No, if you look at, of course, gross margins have gone down. You're right. Yes. But when you look at the BIPs at the PBT and PAT levels, it's about 90 BIPs up or 120 BIPs up at the PAT level. So we continue to look for opportunities to get the net profits healthier. And it's a trend. We suffered a dip, as we discussed in the past discussions, but now we see some uptick coming up.
I think the big question is that will there be more pressure in margins before that uptick comes through, right? Because, it's a 3-year low that you're sitting at, and it's not like the margins have fallen by a tad bit. It's at 12.8%. It's a big fall, over 330 basis points compared to last quarter. So do you think, is there a possibility that the margins could fall further? If they do, is there a possibility it could go to single digits as well before recovering?
We are absolutely trying our level best to make sure that we are driving all the things that are in our hands, which is essentially the productivity part, the cost control, and also choosing the healthy orders and the mix in our orders that are in the pipeline, right? So I see that we will manage that well, and we will try to get the trend, which is already upwards when you look at YTD level, to keep going in that direction.
But are there still some more low profitability orders that have to be executed in the remainder part of the fiscal, which could put further pressure on margins in Q4?
Well, these are long cycle orders in the backlog. So some of them could be a little bit challenging. But we do have ways to mitigate some of those risks in the backlog
Okay.
while choosing the healthy front log in the
Okay.
pipeline.
All right, Mr. Gaikwad, we need some more color here. I'm going to try to get more out of you. Have margins bottomed out? Have margins bottomed out? Not too long ago, you were doing margins in the high teens. Now you're doing margins in the other side of the teens, So will we get to the high teens margins, say in the next 3-4 quarters? Is that the plan? And have margins bottomed out?
So as you know, for Honeywell Automation, there is a healthy mix of the domestic orders and the exports. And you asked that question earlier
Yes.
on.
Yes.
We have a cost advantage, as you know, from our engineering exports perspective. But what we are pivoting to now is not just depend on the cost arbitrage, but also the skills development. And there are new skills in the economy that is developing. See, we are tethered to the growth in North America, West Europe, and Middle
Mr.
East.
Gaikwad, Mr. Gaikwad, the street would just like to know at least a directional call on the margins. Do you think that they will improve from here on, maybe in the next 2 quarters, 3 quarters? But, with the kind of measures that you all have taken, with the mix, with the selection of orders, do you believe that, in fact, margins will trend higher from here on? And also, what is the color with regard to FY24? Going by the orders that you've already secured, what kind of a growth can we look at? Go ahead, sir.
That's where I was going, Nigel, that when we look at these 3 large regions from where we get the exports business, I think Middle East is still looking good, right? Which is a good news. West Europe, you know the situation there. And North America, it's kind of bracing itself, but we still see, not too much of an impact from there. So I'm very optimistic about the export side. The second thing, when you talked about FY24, look at the budget. There is a large capex boost that has come in, and our company depends quite a lot on the capex that goes into the industrial and the infrastructure segment. The second thing, which is very healthy, is specific skills in pharma, life sciences, in the new energy transition, which the country is going through. We are developing the solutions as well as the skills in those areas, and I'm very, very optimistic about it. And the previous trend that I have discussed with you, which is industrial digitalization as well as cybersecurity, they are gaining traction all the way through. So therefore, yes, I am cautiously optimistic about the margins as well.
Can you give us, cautiously optimistic on the margin. So you're saying that there could be some more pressure in Q4. Can you give us the number for the export orders? What is the 9-month FY23 export order book like? And you said that Middle East is seeing a bit of a pickup, but Europe is still a challenge. So do you think exports could worsen in Q4?
Well, they will not worsen, and they are growing at a healthy single-digit rate right now. It's in the range of about 7 to 9%. And we would like to focus on specific areas now so that we can make it better. But that's what I can give you at this point in time.
What about the order inflow, sir? For the 9 months, what has been the order inflow growth on a year-on-year basis? And exports, since you're seeing some traction out there, I recall I've quizzed you in the past as well. Do we see exports getting back to around 1,300, 1,400 crores in the coming year? So one is on the order inflow and then on the exports revenue guidance. Very quickly, and then we'll wrap this up.
Sure. So firstly, the order intake has been a little muted. I would say about 6.5% right now YTD, which is at the rate of GDP, right? And the reason for that is we've been extremely careful after the pandemic on looking at the quality of the orders, the cash flow, the margins, the exact question that you are asking me. Coming back to whether we will get to those levels that you mentioned, 1,300, 1,400 crores, again, like I said, it'll be speculative, but we are doing actions that will get us more share of the pie out there.
Got it, Mr. Gaikwad. We'll leave it there. Thank you very much and good luck. We'll speak with you soon again. Appreciate you joining in. It's always a pleasure having you with us here on the program, on the channel as well. The market slipped a bit. We're down